We're joined now by William Harris, the founder and CEO of Elumynt, a performance-driven e-commerce marketing agency and the host of the UpArrow Podcast, which focuses on helping e-commerce and retail brands scale. William is a top 35 e-commerce expert and top 75 SaaS e-commerce influencer who helps e-commerce and SaaS businesses accelerate their revenue and user growth using modern intelligence strategies. In this session, William will present advanced strategies and tactics for optimizing ads around profit, enabling e-commerce brands to unlock the next chapter in their growth story. Hello, William, and thank you for joining us again this year. I know you've participated in CommerceNow in the past, and it's great to have you back.
Yes, thank you, Shannon. Very excited to be back. One of my favorite events. I love being here and talking to everybody. One of the things I always appreciate, and this was seen in just the last event or the last speaker too, is the audience is very good about asking some good questions, and I like seeing that engagement. So,
yeah, they sure are. And ad spend represents a big chunk of most of our marketing budgets, so we're super keen to learn how to optimize our return on investment with advertising.
Cool. Excited to share some deep, fun stuff here today.
All right, well, let's dive in.
Cool. So I can remember when my oldest daughter started kindergarten, and I'm walking her down the hallway of the school there. And just as we get to the door, I give her the normal dad stuff, right? Of like, okay, be nice, share. You're going to do great. You've got this. And before I left, I said, all right, hey, babe, give me a high 4.9 repeating. I held my hand up and she gives me a high 5. Because what she knew, she didn't understand, but she knew because I told her, is that 0.9 repeating is the same thing as 1. It's not approaching the limit of 1. It's not approximately 1. They are different ways of writing the exact same number. And I say all of that, and if you don't believe me, I'll send you over some math proofs later. But I say that to say that what follows, I'm a big nerd, and what follows is a very mathematically nerdy approach to advertising. If you like numbers, you will enjoy this. If you don't, I apologize. We're going to be talking about optimizing ads for profit because ROAS, MER, contribution margin, LTV CAC ratios, they are all great metrics, but they can lead to some very scary situations if you're not careful. We're going to look at 3 main levels of optimizing ads for profit. They're going to start off basic, then they're going to get progressively more complex from there. Because what I've found is that while many of you may already know some of these basic things, marketing and finance often aren't on the same page with these metrics. So we're going to look at problems with ROAS, MER, and contribution margin. We're going to look at problems with SKU profitability, and then we're going to look at problems with LTV to CAC. So does this look like a healthy company? If this was your company, and let's just pretend it is, you see the MER is trending up very nicely from 6 up to over 8. I'd say most of us, hopefully, would be happy with this. And just to make sure they're on the same page, MER, total revenue divided by total ad spend, in case that's a new metric for you. I think most people are on that now, but if you're not, that's what it is. This would be a good look, right? You're up and to the right. Let's look at this one. Same company, contribution margin, again, moving up and to the right, going from 25% up to over 30%. Most of us, hopefully your CFO is like, hey, great job. I'm happy with this. If you look at contribution margin and MER together, hopefully this is intuitive to you, but there's a good positive correlation between the two of these numbers. It's not always the case, but it's almost always the case. So I at least wanted to just highlight that. So right now we've got 3 charts, all of which look like they're a really good company that's in a really good, healthy spot. So why did I show you 3 charts that obviously look wonderful? Well, because the 4th chart doesn't look as nice. So this is what actually happened in this situation. The blue line still is MER, up and to the right, looking beautiful as ever. The red line, though, is the actual amount of EBITDA profit that this company was generating. So you can see as their MER went up, their profit went down. And in fact, their March went negative and stayed negative the next 2 months. So this is bad. Finance isn't happy. Marketing's not happy. Nobody's happy. Except for somebody's happy. Your ad agency. Your ad agency is patting themselves on the back. Why? Because you told them to increase the ROAS and MER. or the contribution margin, and they did that. And very successful, I might add. These are all from the same spreadsheet. And we'll look at this in a minute. It's what generated this. But you can see the MER, ROAS, everything's looking really, really good from all of these metrics. So how can this be? How can you have a better ROAS, a better MER, a better contribution margin, but worse profit? I'm sure some of you are already there in your head. I can see the wheels turning there. Let's look at the rest of the story here with this. So these are based on real client numbers. And if you can look at these charts here that are in here, you see the purple line there. That's the MER. So it's going from 6 up to over 8.8. You can look at the contribution margin. That's the second to last row there. And then the profit there down at the bottom. So it goes negative in March. What's missing though? So if you look at this, the ad spend goes from, it's the green line here, the ad spend goes from about $200,000 a month and then drops to $100,000 a month in March. The problem with that is while it did get more efficient, the MER improved quite significantly from where they were, it wasn't enough ad spend to actually compensate for their overhead. And you can see the overhead there is $266,000 a month. And so these values over here, they're COGS, shipping cost, overhead, returns. So what happened? Well, finance told marketing, hey, you guys need to improve the contribution margin. Marketing then tells the agency, hey, we need you to set higher MER and ROAS targets, goals here. The agency then goes into the ad platform and says, all right, well, we've got to cut this campaign because it's at a ROAS of 1 or whatever that might be. And we got to cut this one. We got to cut this one. And so what's left is a more efficient ad account in terms of higher ROAS. But it's often with things being left in the less incremental campaigns. So things like branded search or retargeting on Facebook or something like that, because those had the higher ROAS in platform, but they were just less incremental and actually driving revenue for the brand. So none of these metrics are actually bad in and of themselves, right? But you can't look at contribution margin or MER in a silo. You need to look at them alongside your ad spend goal and ideally even alongside your overhead to understand the bigger picture of what's actually happening. So remember, I said we're going to go through 3 levels. So we're going to start with level 1. Level 1 is optimizing ad spend for aggregate profit. Why start with aggregate profit? Well, because I like to pull back and look at a wider view first. So there's 4 examples here that I want to go over. Same company. So you can look over here, the COGS, the shipping cost, the overhead, returns. All of those are the same numbers. We're going to look at example 1, 2, 3, 4 of what could have happened or how we would look at this at optimizing towards this aggregate profit number. Green line, ad spend, $200,000, MER of 6. It's going to leave them with a profit of about $35,000. Example 2, let's say they bump up that spend a little bit, so 200 to 225. Now they're going to drop the MER a little bit down to a 5.7 as they expand and push out. But that aggregate profit number now for them is going to be $45,000, a little bit better. Example 3, let's say they push all the way up to $300,000 in ad spend. MER drops down to a 5, and profit, though, is up to $60,000. So if you're just looking at MER, you're thinking, wait a minute, going from a 6 to a 5, I don't like that. But if you're looking at the profit, the aggregate profit, this is a better scenario likely for this brand. And then example 4 looks at us going the other direction. What if they drop the spend down to 175, increase the MER to 6.5, they're at 35,000. So either one of these options here, 1 and 4, are about the same. But I'd say 1's still going to be better than 4 typically because they've acquired more customers, which is going to have a bigger overall lifetime value to the brand. So I'd still argue in favor of example 1 over 4. But it's important to note that increasing spend will lower the MER. It's not a good thing. It's not a bad thing. It's just a thing that you have to be aware of because you're reaching out into bigger and broader audiences. Maybe you're relying now less on other sources of revenue from organic, direct, email, et cetera. Those are making up a smaller overall piece of the pie compared to the ad spend. So it's typically going to go down. The other big thing that you need to make sure that you're looking at with this is you have to have accurate projections, including inventory. If we had a customer one time tell us that their goal was to double their ad spend this month, but when we dug deeper a little bit with them, we found out that they only had 50% more inventory. So that's not going to work out very well. You can't double your ad spend if you only have half as much or 50% more inventory. And so that's got to be on par as well. But the key here is to make sure that you're looking at two inputs here, the MER with the ad spend. That's the key. So the MER alone, contribution margin alone, any of those other ones alone aren't good if you don't understand what that means in relationship to the ad spend. You can't just drop the ad spend. And then ideally evaluate those, I guess, both against the overhead, right? The other key thing to acknowledge on this is that it's looking at approximate profit. This is not the actual P&L. The actual P&L is going to fluctuate a little bit. This is looking at things if we say, okay, let's just level set here. Is this moving in the right direction of where we want to go? Okay, so that's a good start. But as I'm sure you're aware, aggregate profit, that's not as deep as maybe we want to go. So let's go a little bit deeper. We're going to go to level 2, what I would call optimizing ad spend for unit profit. The classic example that I like to give is this. You've got two products. Product 1 is $200. Product 2 is $100. That's what they retail for. You've got a $50 CAC. So product 1, 200 divided by 50, you've got a 4-to-1 ROAS. Product 2, $100 divided by $50, you've got a 2-to-1 ROAS. Now, just looking at those numbers, which is what a lot of people do, product 1 is the clear winner. And that's what your ad agency is often optimizing for. That's what your marketing team is often optimizing for. The ad platform is optimizing for that. So a lot of times, this is what you're doing. You're saying, great, go after more of those 4-to-1 ROAS. Let's be excited about that. In fact, if you told the agency to optimize for ROAS or CAC, product 1 is going to win. Everybody starts celebrating, but then you get a call from your CFO because he's not happy or she's not happy. Why? Because, well, let's expand this. They weren't looking at margin. So your ads team, your marketing team, they weren't looking at margin for these products. So product 1, $200 price point, but only a 25% margin. So the profit on that one is $50 before you've got the CAC involved. Product 2, $100, it's got a 75% margin. So the profit that you're getting off of that one is $75 before the CAC's involved. Once you factor in that $50 CAC for either one of those products, product 1, which has the 4-to-1 ROAS, now has $0 in actual profit bottom line to the business. Whereas product 2, which only had the 2-to-1 ROAS, has $25 in profit. Arguably, for most businesses, that's much better. The problem is that when you're not looking at it this way, if you're just looking at it at the ROAS level, you are likely spending and optimizing around the wrong products. Your ads team is, your marketing team is, you're training the algorithms on Facebook and Google, et cetera, to optimize for the wrong types of purchases that are beneficial to your business. Now, there is an argument to be made for cash flow, but most brands want and need EBITDA. Why? Because profit allows you to outspend, outmarket, and outlast your competitors. So cash flow aside, other goals aside, for most businesses, this would be a better way of approaching this. That gets a little bit deeper. Let's take that an inch deeper here. So going to what I'm just going to call level 2.5. So we're not going all the way to 3 yet. Optimizing ad spend for unit profit enhanced. Same concept as the last one, but this time we're looking at 4 products. Okay. Product A, $100, 30% margin, gross profit of $30. Product B, $200, also 30% margin, $60. And the reason why I included that way is because sometimes people will optimize campaigns around margin percent, but not margin dollars. And that's a big difference because both of those could have a 30% margin, but have a very different profit dollar amount that's coming from each one of those products. Product C then, $400, 10% margin, $40 profit. Product D, $50, 70% margin, $35. Now, if we're just looking at these here, clearly product A and D, not as exciting. Product B, big time winner. Product C, pretty good winner. Either one of those is a pretty good one. So optimizing around this number, I'll tell you, will be a significant improvement for a lot of businesses, a lot of e-commerce businesses. But we would still beat the pants off of you. And here's why. Let's take that a little bit more. Again, expand the table. What's missing from that last slide? So in this slide, you can see we're also looking at yearly purchases of these products. So product A has yearly purchases of about 3. Product B and C, 1 each. Okay, that you just buy it one time and you're done. Product D, 10. So basically a monthly consumable. Now, if we add that to whatever the gross profit was, then we can look at the yearly gross profit for each one of these. Now subtract our CAC, and we can look at that final column there of yearly profit off of each one of these. What seemed like the biggest winner, or one of the biggest winners, I would say, would be product B, product C. Those both looked like great winners in the last look. In this one, they're both the losers. Product C had an 8-to-1 ROAS, right? $400 divided by a $50 CAC. You're looking at an 8-to-1 ROAS. In platform, you're thinking, this thing is absolutely crushing. Optimize everything to sell this one. But the yearly profit on that one is -10. So that's not good. Product D, which looked like the clear loser, or at least one of the losers between that and A, all of a sudden comes out now shining like a rose here. It's $300 in yearly profit. So I think the key to look at with this is you have to understand how these factors, both the profit, the margin, and the frequency, contribute to which products you should be optimizing towards, and possibly setting different goals for either different categories within your business, or even at the SKU level. We oftentimes optimize towards the SKU level for a lot of things because that can make a big difference. Now, I want to call it here that product C, even though it's a loser here at -10, it may be needed for product D to even sell. Maybe product C is like this base system that somebody needs to buy in order for them to get into your consumables product D. So there's no need for product D without product C. So you have to look at this with your own business. You can't just decide, hey, we're going to stop selling product C, only go after product D. You need the users on product C to have the need for product D. There's also a lot of talk about just letting Facebook do its thing, that it's smarter than humans. There's a lot of decision-making capabilities that Facebook is very good at, and the other ad platforms. And I'd say that I'm in favor of that for a lot of decision-making, but I'm not in favor of that when it means that those algorithms don't have all the data. So yes, they will help you get the cheapest CPA. They will help you get the highest ROAS. They will help you get the most purchases with a set cost cap. But hopefully, as you've seen already, all of those can actually really screw up your bottom line. And so Facebook doesn't have your bottom line for a lot of this, although you can send a lot of this data in. But for most people, Facebook doesn't have that. And so it's not optimizing around that. And if it's not optimizing around that, then allowing Facebook to just do its thing could be very detrimental to your business. Okay. Did you catch the blunder? I intentionally left one blunder on that last slide. It's not so much an error as much as just what I would say is an omission of taking this even one more layer deeper. Excuse me. We'll get to that blunder in just a moment. But before we do, I want to look at level 3, optimizing ad spend for the average new customer profit and the average returning customer profit, because LTV to CAC just isn't good enough. Let's look at this client. Okay. If all you knew about this client was their CAC and their LTV, would you say they're in a decent spot? They're acquiring customers for $55. That's good, especially if we look at their LTV of $491. It gives us an LTV to CAC ratio of 8.93. That looks great, right? Again, the problem with this one is there's no acknowledgement of profit, which is very dangerous. So here's where we're going to get to the blunder. The blunder is we were looking at repeat purchases without having any spend to re-engage those customers. So let's look at this now. What I would say is the problem with LTV to CAC, which is that it's not looking at the profitability. These are exact numbers from a client, by the way. So in this situation, again, the agency had increased ROAS like they were asked to, and this company continued to lose money. Why? Because for them, LTV to CAC ratio is a smart analysis, but it's blind. A better analysis is the average new customer profit compared with the average returning customer profit, which you can see down below there. So for this customer, their average returning new customer profit was -$54. That's not uncommon, and that's not even a bad thing for a lot of first purchases. For a lot of businesses, that's good approach. That's a good approach to gain market share. You're going to lose money sometimes to acquire a customer. Where this becomes a problem is their returning customer, the average returning customer profit is negative $12. So that means they lost money on the first purchase. And every single time somebody comes back and buys from them, a repeat purchase, they continue to lose more and more and more money off of each one of their customers. So their LTV to CAC ratio looks great. When you look at what's happening here, though, there was absolutely no way for them to dig out of this hole. Every time they acquired a new customer, they're acquiring more potential debt along the way. So let's look at this. I find that almost nobody in D2C is looking at these numbers. So I want to walk through them a little bit. Their spend total for this particular customer is $35,000. Their new customer ad spend, NC ad spend, is $34,000. I like that for a smaller brand. I find that a lot of times brands are spending way too much trying to re-engage customers when in reality they should be a little bit more focused on just going out and acquiring new customers and ideally your product and a lot of the other things you're doing, your email campaigns, your SMS campaigns, et cetera, should be able to re-engage people. CAC of $55, that's great, especially compared to their NCAOV, their new customer average order value, which is $176. So that's good. They spent $55 to acquire a $176 purchase. A lot of things look good. They're doing a lot of things well from those perspectives. But the problem is that their entire formula was just broken. So when we add in their COGS of 29%, and we add in their shipping costs of 19%, and their returns costs of 7%, and their other variable costs of 2%, and we add in their overhead of $54,000, the problem was they were in a situation where nothing they did was allowing them to turn a profit unless they made some significant changes. I want to look at a couple of other scenarios that are like that. So the first image here on the left, that's that one that we just looked at. Let's look at the one on the far right. This customer spending $200,000 a month. Their average new customer profit was about -10. Again, I'm pretty okay with that -10, especially because their average returning customer profit was $12, which meant that, yeah, they lost a little money on the first one. They're acquiring new customers, new users, and then they're making money every single time that person comes back to purchase from them. And then the middle one is another really great example. So their average new customer profit was $8, and their average returning customer profit was $35. That's a great scenario. If I was going to push them on anything, I would almost say maybe you want to go a little bit more aggressive on acquiring new customers because you're very profitable on those repeat purchases. That's a mixed bag. They could be just fine right where they're at. A lot of that would depend on the overall resiliency. Do they have cash in the bank or not, right? Depends on the frequency or at least the time to that second purchase, third purchase, et cetera. If it's a 9-month leadway, well, that's a big burn rate for them to lose money on that first purchase and wait for that second purchase. So that's just a lot of risk. Market environments, things like that. There's a lot of reasons for why there's nothing wrong with actually still being profitable on the first purchase. And not being as aggressive and losing money on those first purchases. But it's not a bad scenario to lose a little bit on the first one either. The point that I wanted to make with all of this, though, is that LTV to CAC won't show you this. You have to look at the average new customer profit and the average returning customer profit to see if your formula can actually work. Because otherwise, the LTV to CAC, again, beautiful metric, but blind if it doesn't understand profitability in that equation as well. This is where I hesitate to even put this in there because it's a bit crazy. Like I said, I like numbers, I like math. If you're curious about the actual formulas, I have them here. I won't spend too much time on them, but the average new customer profit equals the new customer average order value minus the average new customer costs. That makes sense. What are the new customer costs? Well, one way that we like to look at it would just be the average new customer profit. It's just that lower line there equals the average, the new customer AOV minus the sum of the average new customer COGS percentage, the average new customer shipping cost percentage, the average new customer returns cost percentage, the average new customer other variable cost percentage, the average CAC, the average new customer overhead, and the average new customer agency fee. So if you, there are ways that we do this. We have spreadsheets that do this, but if you calculate all these out, then you can kind of get all those in there. Now there, you could get even more granular than you want with this, but these are the ones that we like to look at as the different inputs, because that allows us to see where the different potential breakdowns are, and things that you have control over, over changing this, right? If we just leave it as the average new customer costs, well, what's making that up, and where can we make changes? The average returning customer profit, the base formula for that is just the average returning customer profit equals lifetime value minus new customer AOV. Well, it's the sum of the new customer AOV plus the average returning customer cost per purchase times the average returning customer frequency. And this returning customer frequency is not your total purchase frequency. Just to differentiate that, this would be, if you have a total purchase frequency of 3.3, this would be 2.3. It's just, the total frequency minus 1, because we're looking at just how many repeat purchases do they make after that first order. So we're looking at returning customers and first customers differently. And again, this is looking at lifetime value. That's actually not the numbers that I showed you back here. Just so we're clear, I didn't want to confuse people by calling it the MRCPP, just because I feel like that gets a lot more granular. This is looking at lifetime return customer profit. The numbers that we're looking at in these charts is actually just looking at that monthly returning customer profit, which is just the exact inverse of, or opposite, not inverse, but of what we have up above here. So it's the returning customer AOV minus all of those numbers, but all of those numbers specific to the returning customer numbers as well. So the COGS may actually be different. And so that's one of the things that we've looked at as well. Sometimes the COGS for returning customers are different than the COGS for previous or first-time buyers. Maybe you have discounts that you're offering to first-time buyers that you're not offering to returning customers, or they have loyalty programs. So segmenting all of these numbers out can allow you to understand a little bit more about the actual incremental profit that you're getting off of each returning purchase. Okay, that's a lot. Let's review that real quick. Level 1, we looked at MER, contribution margin, ROAS. These can all kill your business unless your marketing team is looking at the full picture and using aggregate profit to gauge performance. Level 2, unit profit helps you take this idea further so you can optimize your campaigns around EBITDA instead of misleading metrics like ROAS. Level 2.5, unit profit enhanced, takes this further by looking beyond just the first purchase to see what the frequency of purchases looks like at the SKU level. And then level 3, LTV to CAC ratio. This is a blind metric compared to the average new customer profit and the average returning customer profit. Now, there is still a lot that I didn't cover here. Like, how do these formulas, how are they impacted by discounts and bundles? There's a lot more that we can get into that's a lot more fun. Whole different topic, though. So right now, I'll just leave it with, if you do have questions, I'd love to hear them. I'd love to answer them. Otherwise, follow me also on Twitter, William Harris 101, Elumynt on TikTok there, and at UpArrow Podcast there on YouTube.
Thanks so much, William. That was very insightful. We do have a lot of questions. This first one's a two-parter. How does the profit from returning customers relate to like a recurring subscription?
How does it relate to a recurring subscription? So that's a good question. Some of our customers do have subscriptions as well. If you have a returning subscription, you have to look at what those COGS are the same way that you would. So we'll go back here on this. You could make a variation of this formula. I usually don't, although sometimes maybe we could break that out. If you've got a subscription, you may want to look at that separately versus just returning customers who aren't under subscription to understand what is the profitability of each one of those. But I'd be looking at it the same way. I'd be looking at, okay, if my subscription is on average 7.5 months, and so I would be using that almost as my frequency now, basically. But I'd still say, well, what was my lifetime value of that subscription if it's $450? If my average returning customer cost per purchase are, $100, because I don't know what your COGS are, but I take that all into account and run that as this, and I could call that the average returning customer profit, and then let's give it, an acronym of S, right? So profit of subscriptions to differentiate it from my non-subscription returning customers.
Okay, great. And the other part of that question, same person's asking, how do we estimate profit if we're selling a digital product? So
That's
like
good.
if they're selling software and there's no hard cost to, distribute that software, what would they use for the profit number?
Yeah, use what costs you have then. So one of the benefits is, like you said, you do have a much higher margin on those, but you would still have in here. You're still going to have. So you might not have COGS necessarily, but you do have your well, you don't have shipping then either. There may be some shipping. So I don't do a lot with digital products, but if I had to guess here, um, how much does it cost for you to ship it? Like the cost of the email to send that digital subscription out, or is there somebody that has to manually do something to add them to this? There are some numbers that you probably should have in here, but average, otherwise, it's just like, what are the numbers that you do have in here? What are the costs that you do have associated with fulfilling that? And there has to be something. There's the data warehouse cost. There's the marketing tools cost, and so there's other costs that you do have in here that you should be including in some way, and they're going to scale. So look at the ones that are scalable costs, right? Not the true overhead costs. And so if you're servicing 10 downloads a day versus 100,000 downloads a day, which ones of those are going to go up in cost for you? Those are the ones you need to be including into here.
Got it. Yeah, that makes sense. Thank you. Another question, what are the typical ad agency fees in the US these days?
Typical? I have no clue. I try to keep up on that. I will say that we've experimented. I can speak to us. We've experimented with a lot of different fees that people look at for these. There was a trend for a while of going after percentage of revenue. We tried that for a couple. I never liked it. And my biggest reason against it is because how do you determine which revenue was directly impacted by that? Google took credit for it. Facebook took credit for it. It was only one sale. Email also took credit for it.
Right.
And so I think that just got really cumbersome. So we still base it off of a percentage of ad spend. So we have a base fee to work with us, which we believe just kind of covers like the minimum amount of money necessary to just get this team involved in your account. And then a percentage of ad spend. It is a relatively low amount. And the point being that if you're spending $10,000 or $100,000 a month, there is more time on our side. There's, again, more data capabilities, more warehousing, things like that. How do other people do it? We do have some flat rates that we do for certain businesses that are very large. They've got their projections out for the next 36 months, and so they want to negotiate that, and that's fine. And they're willing to sign longer-term contracts. And so, somebody signing a 2-year or 3-year deal or whatever, you can get into something like that. I do know that some people have started charging based on basically just like the amount of people that they're resourcing on it. I think the key that I would look at for all of those different methods is that there's going to be a trade-off in every single one of them. If you go pure flat rate with some agencies, and a lot of them do, right? One of the issues is that they're not incentivized now to really grow the business. I mean, they're incentivized to grow it enough to make sure that it's, you're happy with them, but they're not incentivized to double the business. So that could be a negative to you depending on the size of your business. If you're looking at this from a resourcing person where it's like, hey, you're going to get 1/3 of this person or 2/3 of this person or whatever that might be, they're still factoring in some element of an overhead or margin based on that person as well. And so yeah, all of them are going to work out to be about the same. We actually have a rule in our business where if we find that an account on our side that we're too profitable on, that we're saying, oh, well, actually we are making too much margin on this, we'll go back and negotiate with them and say, hey, we're actually, we're going to lower your fees based on where we're at and how much time that it's actually taking for us to manage your account. So there should be some calculation that's along those lines.
Well, that's refreshing. That's great. And another audience member is just asking you to revisit the MER calculation and how you calculate MER.
Oh, sure. So MER, the basic calculation is just total revenue divided by total ad spend. There are other ways that you can look at it. The thing that's nice about MER as opposed to ROAS, and I would say that I don't even like the term ROAS. I have a whole article about what I call the ROAS death spiral on the website, because ROAS is not the actual return that you've gotten from the ads. It's just the reported return. So it's just what it was able to identify and track and attribute to that ad. It's not the actual return you got. So that's step one. Where MER is nice is if it's total revenue divided by total ad spend, it eliminates some of that duplicative effect that may have taken place. And so if Google took credit for it, Facebook took credit for it, email took credit for it, it was still just one sale. MER kind of level sets that. Where MER is not the greatest, as we've seen in some of these contexts, is it doesn't tell you which ad platform should get the most credit for that. And so that's one of the downsides there. So we still use ROAS in platform, but we like MER as another gauge to understand just overall how healthy is the business. If we've doubled ad spend, did the MER go up, down, stay the same? Where are we at overall?
Okay, great. And another question is, what if our overhead fluctuates a lot each month?
Yeah, so this is where I'm not a CFO, so I can't answer this one as deeply. But I will say that when I talk to finance people, they usually say that your overhead should not fluctuate that much over each month. That's the whole point of it being overhead. If it's fluctuating a whole lot, you maybe need to work with a finance person to understand what's really overhead and what's not overhead,
Right.
because
Like differentiating
your
those
overhead.
variable costs.
Yeah, exactly. Those might be variable
Mhm.
costs. Now, where some of these could be fluctuating, we've run into this for an account before too, is like I think they pay their insurance yearly and it's due in February. And so all of a sudden you've got this, $100,000 bill due in February that you don't normally have due. So we look at that, like, well, how do you amortize that out? And that's kind of why we look at this. We say, what's your average overhead over the course of 12 months? And that's the actual P&L might vary, but you say, okay, I'll average that out to $10,000 a month or whatever that is. It's $120,000 a year. So the average that we're paying for that is $10,000 a month. And there should be some way for you at least to amortize some of those things that are in your overhead that might be yearly purchases too.
Great, thank you. Well, thanks again, William. Really enjoyed your presentation today. Thank you for sharing your expertise. As always,
Likewise,
it's good to
Shannon.
talk to you.
Thank you.
So it's
Very good to be here.
yes, it's time now to take another short break. We'll be back with our last session of the day, so don't go anywhere. Be back shortly.